Hi, good morning, everybody. I'm delighted to be back at the European Blockchain Convention for the 10th edition. I've been coming for several years now, and it's really quite incredible to see how much the team has done a good job at scaling this conference and seeing so many familiar faces today. So I'm delighted to be here with my panelists to talk about the future of asset management in a tokenized world. There's a lot of weeds to get into, and Laurent kindly set the scene for us, closing the earlier panel. But before we get into those details, could I please ask my panelists to introduce themselves and just give a little bit of background into the work that you do in each of your organizations? Yuriy, do you want to kick us off?
Yeah, sure. Hi, everyone. Good morning and really happy to be here. My name is Yuriy, and I'm the founder and CEO of 3Commas. I've started this company 8 years ago with an idea of democratizing the use and trading in crypto. So what we've done is that we've built a platform that, especially a couple of years ago when the retail market was on its rise, was the biggest one in terms of automation, no-code solutions, no-code solution in how people would trade in crypto. With the switch that happened in the market in the last 3 years, our main focus now is bringing the asset management tools for individual professional traders, small asset managers, funds, and I'll be really happy to share the insights on the technology and how technology is really shaping and shifting this market and setting up the stage on what's coming next in the next 3 to 5 years. Thank you.
Thanks. Barnali?
Good morning, everyone. I am Barnali Biswal. I am the Chief Investment Officer at Hilbert Capital. Hilbert Capital is a crypto-focused asset manager. We have been, I'm not sure if we are the longest recorded track, but one of the longest recorded track holder in the crypto hedge fund industry. We focus on various active strategies, trading liquid strategies, that is within crypto. And Hilbert Group, which is the parent company of Hilbert Capital, also has other focuses within the Web3 space broadly.
Fabian?
Good morning from my side as well. My name is Fabian Dori. It's a pleasure to be here and to discuss the future of asset management in a tokenized world in this round. I have the pleasure to head the asset management division at Sygnum, a global digital asset banking group founded on Swiss and Singapore heritage. And while we provide tokenization services on our own, I myself, in my role, are much more focused about the investment opportunities, the ways to improve portfolio construction, diversification, etc., arising out of tokenized assets.
Thanks so much. So if we could just take a little bit of a step back to set the scene a little bit before looking at the ways that tokenization is actually influencing the future of tokenization. And asset management at that. Can you maybe just tell us sort of what are the key drivers at the moment that you're seeing? What is influencing the uptake, and what are the key benefits actually that you're seeing within asset management tapping into the Web3 space? Fabian, you're nodding. Do you want to get us started?
Sure. Maybe one step back. When we talk about tokenization, I look at it from an asset management perspective. So for me, it involves 3 dimensions. First of all, the investment management per se. Second, the operations part of it. And third, the structuring. From an investment management perspective, it's all about increasing the eligible asset universe, the investment universe, making it broader, accessing new sources of return, new sources of diversification. On the operations part, it's obviously all about efficiency scaling, cost reduction through automation, through programmability, etc. And then on the structuring side, it's all about not only bringing assets on chain and in a digital form, but also bringing portfolios and ultimately the full asset management value chain on chain. And I think what drives right now the tokenization topic is that mosaic of different pieces that need to come together in order to have a proper and nice mosaic together. Those pieces are coming step by step into place. We have relevant assets on chain, tokenized treasuries, stable coins, deposit tokens and the like. We have relevant players interacting with those puzzle pieces, BlackRock, Fidelity, Maker, Sky, and the like. So all those different elements are now coming together and help push forward the adoption.
Thanks. And Barnali, Yuriy, anything to add?
I would, sorry. I would just say that if we will again think of what are the key reasons and what is happening when the traditional assets are being tokenized, is first that you get fractionalized assets, so you get instantly much more liquidity and 24 access to that liquidity, which, following to what Fabian said, heavily increases operations efficiency and everything related to that. The second big part would be the regulations and everything that comes there, because as we see now with the frameworks that are rising, like MiCA, for example, this allows the new technology to actually be implemented on a much larger scale, which again brings more buy-side, sell-side interest. And right now, in 2024, we can say that the industry has finally matured in a state where it can start getting adopted by the wide masses and the professional asset managers, as we see here. The last thing that I will mention right now is everything related to security and transparency, which is usually a big problem, and it's a tough challenge to tackle. But again, technology plays a major role here, allowing any qualified assessor of the situation to actually see what is happening there and then take measures that are really needed at this stage.
Yeah, what I would add is kind of a perspective on tokenizations that's twofold right now. One is the way traditional asset managers slash market participants view tokenization, which is largely about adopting the blockchain technology, smart contracts, oracles, etc. That's largely from a point of view that reduces friction. Whereas the crypto world views that as Yuriy was pointing to, synthesization, meaning you're bringing these two really same part of the finance world, but you're bringing them onto same operating system, so to speak. So what happens from a crypto asset manager point of view, we all of a sudden see a bunch of much less volatile asset being brought on chain, which then can be used for collateralization, other such things, ultimately leading to probably dampening of volatility and more synthesization between the two worlds.
I mean, so that's really interesting, and I think it paves the way a little bit into the next bit of the conversation, which when we were chatting ahead of this, one of the big things that we were focused on was sort of around the risk management angle and how buy-side asset management at that are looking at risk management protocol of tokenized assets, crypto assets more broadly speaking. And so maybe you'd want to turn to the investment managers in the room to sort of like hone in on that a little bit. And so, Barnali, on your point, what are the differences that you're seeing from an asset management side on the, the risks of tokenized assets versus crypto assets and that traditional assets as well, and how is sort of buy side from a more broader perspective looking at that risk?
Sure. I will qualify this answer saying there is the utopia and there is today's reality. The utopia is that, everything will be extremely easy to, or rather, the user experience will be multiple times better than what we have in the traditional finance world. We're not there. That's the ideal. And then the risk angle that your question is guiding towards, that's several-fold, right? If you think about traditional, any asset manager that you take, one of the key risks that they do have but do not visualize in an acute manner as much because of regulation guardrails and infrastructure around it is actually counterparty risk. And it's so papered over and beyond sort of, or abstracted away from the day-to-day trader slash portfolio manager slash asset manager that, that pain is there, but it is not publicized enough vis-a-vis crypto world where, we have a counterparty blow up pretty much every few years so far. So, however, if you think about what tokenization is actually doing for the traditional assets, it is removing a lot of those kind of both credit counterparty related risk that exist in that system due to the frankly antiquated technology that it's built upon. Whether that is settlement or we're talking about even just access to trading in over the weekend or 24/7, those kind of things actually they actually cost dollars in any trading book. It's not quantified enough away from obviously inside any big bank or any big firm that is quantified, but not to the public. So in my mind, there is the risk management when it comes to investment side of the things. Then there is the risk management that is more operational / infrastructure related. And I'm sure Fabian actually will have more to say on this because they sit kind of in the middle of many of the other things. But in my view, it actually does mitigate a lot of these age-old issues that we have had in traditional finance.
So, Fabian, do you see that sort of bifurcation between the two kinds of risks that Barnali was mentioning?
Yeah, very much agree to what Barnali said. First of all, we are not yet there where utopia hopefully brings us. So my answer is very much out of the trenches. And I would say, I would look at it out of two dimensions. One being the single asset class dimension and the other one more being the portfolio dimension. From a single asset dimension, I think it's very much what you said, Barnali, right? The risk categories are still there. There's still credit risk, there's still market risk, there's still liquidity risk, there's concentration risk, and so on. But the nature of those risks might change when you bring an asset on change. For example, the liquidity risk might improve because there is now potentially a second market around a formerly illiquid asset, so there's an improvement on that side possible. On the other hand, the counterparty or the credit risk might become more difficult or more challenging, as you now have also to deal with additional technology risks, smart contract risks, and the like. So on a single asset dimension, I think that the question is more complex. But from a portfolio point of view, there's clearly an advantage in the sense that the tools are there to construct a better risk-return profile. Broader investment universe, decorrelated assets, smaller ticket sizes to handle with. And then obviously, what you said, keeping the operations in mind, where to store the assets, what are the liquidity venues, what are KYC, AML topics to be kept in mind. So the complexity, I would say, increases on those levels.
That's super helpful and very interesting. So just to sort of highlight a couple of the pieces from that and then maybe turn to you, Yuriy. On the operational side at least, like the programmability element that sort of helps reduce the risk around like a lot of the sort of what I think Barnali mentioned was the antiquated technology that sits behind a lot of traditional financial asset management. Yuriy, in the work that you do, how do you see sort of the AI piece facilitating more of that automation programmability, and how is that actually going to influence the future of asset management from your perspective?
I will answer this in the following way. So first of all, let's think about the trends and what is happening in crypto in general, because I will be more talking about the technology and the crypto side compared to the traditional asset management side. So first of all, think of who asset managers in crypto world really are, right? So yeah, you have the big guys who are sitting in the banks, and now they get more and more exposure to crypto through ETF and the other different funds. Then tools, I mean. And then you have traditional crypto native funds that were around since whatever 2013, I would believe, who would just invest in Bitcoin and other stable or let's say robust crypto assets. And their main problem of all these years was, how do we make the compliance and everything else suitable for the proper investors, right? Now, let's talk about the things that were happening again, 3 years ago and then that we see happening now. For example, could you call like meme traders and everything that is related to this hype about meme coins or NFTs or anything else that come and go as a trend, can you call this? Can this be called an asset manager? And asset management, is it an asset really? And what tools and what requirements are there? So a good example of that would be there is a growing interest for people and proper funds buying locked second-hand tokens of big projects, for example, right? We know what happened with FTX and Alameda and how a huge portion of locked Solana tokens, for example, got locked in there. Other tools and methods and technology on the market that would allow for proper assessment of what the value is and how do we actually manage that, how could we package that and bring these products into the market. Now coming to what you were asking about AI, actually AI would play a huge role here on every level of everything that I was talking about. So first of all, proper data-driven analysis and being able to actually figure out new models or even implement old models, but relay them to the conditions of this market. AI would play a huge role here. If we would dramatically switch to everything that is actually like Web3 native and talk about smart contracts, how they are being executed and how tools that are built there, they need some parameters to work on, right? So think of a system, of a portfolio management system, purely working on-chain, Web3, and everything else. Well, AI would impact greatly in terms of how quickly the system can adapt, how quickly this strategy will be executed. And in the end, it all comes in terms of better efficiency for people who are actually using that. So AI has already changed our world in multiple ways. Being able to interact with this huge amount of data and actually make qualified decisions. So in the next level, we'll see this happening this year, but especially in both asset manager, in the traditional way and then on the pure Web3 tokenized way. The trend and the big companies that are raising huge rounds right now from Y Combinators and crypto native startup funds, this is all related to how do we now, it will be pretty simple. How do we implement technology like ChatGPT and others into making these qualified decisions that we really need to make every day, and how to make them as efficient as possible?
No, and I think that's incredibly important when you're thinking about that future landscape as well. Like, what are sort of the influences in terms of that decision-making process? So, thanks for walking us through that. I do want to give a bit of time to at least the title of the panel, which is the future of asset management in a tokenized world. And so, I think that's something that I spend a lot of time thinking about within the work that I do at GDF, and that's really thinking about what are the models going to be looking like in, like that projection 5-10 years time. Are we looking at a model of convergence or, sort of, I suppose, separation where you see different entities sort of a bit siloed, I suppose. And Barnali, to your point, I wonder for you in the asset management space, are you seeing sort of a stronger convergence between management of tokenized assets, crypto assets at that, and traditional finance too? How are you seeing that unfold?
I think this is a broader question in my view, because the immediate benefits of tokenization, and when I say tokenization, I do not mean digitization, but actual usage of distributed, ledger technology and peer-to-peer trustless transaction. From that point of view, within the asset management landscape, this is more likely to have the first impact in more illiquid sort of arena, whether that is the VC funds or private equity or art and intellectual property, carbon credits, whatever, any of those, because those are easy to sort of understand the pain point and really address it with the technology or where the technology is today. Largely that boils down to injecting additional liquidity via tokenization. That's one. And number two is providing fractional ownership / access to whether that's retail traders, other liquid asset managers, etc. So I feel that's where majority of the immediate demand is largely probably going to come from. On the other side of the world, which is more liquid in nature, if you see what sort of like the largest asset managers currently are focused on, they're largely bringing yield on chain in one format or other, whether that's BlackRock, Franklin Templeton, BNY. I mean, we can go around and see different projects that they are involved in, but in one form or the other, it's providing real world yield. When I say real world, I mean traditional yield onto the crypto user base. In that frame, the liquid asset managers, for us, it's largely about, it's actually extremely beneficial, as Fabian was mentioning, in portfolio and risk management, right? Because it just provides easier diversification, a stability to the collateral base, etc. But I do see further, kind of to Yuriy's point, trend towards more data-driven, newer forms of security that are part tokenization, part crypto in its real sense. But how that sort of changes the market structure, in my view, is still to be seen.
Gentlemen, anything to add?
Well, I would continue this and make an example of, so you made some examples of what assets were tokenized already, and then coming back to your idea about what the utopia was and what we actually have now. Let's talk about real estate, for example, right? So again, the whole notion of all the projects, 3 to 4 years ago, that, well, real estate, it's a very good asset in one regards, but the other thing is that it is very illiquid. It is very hard to, on the compliance side, to put it on the books and actually work with it. So, okay, tokenization, crypto will solve this, right? We will tokenize everything and then it will actually work. Well, what we see 4 years ago, that I wouldn't say that it doesn't. It actually does in some communities and countries. There are frameworks that actually make it happen. But on a global scale, it still didn't happen. Why? Well, because compliance and regulation and security plays a huge role in this. So when we talk about the next, 5 years of what's going to happen, first of all, I am a strong believer into fractionalization and then bringing more and more liquidity into the space, because, well, we cannot deny that this is happening, right? But I would also say that for every good thing that the technology brings, there are also challenges that are brought with all the pyramid schemes and with all the global movement of trying to push regulations and ban them as far as possible. And then what we see that, well, the governments and the regulators, they do not appreciate that, and then it affects the industry in a bad way. So it's like a back and forth process. But the trend, I guess you cannot deny the trend that tokenization and then crypto is playing is bigger and bigger role in the whole asset management class, and it will continue to go there. Again, implementations of AI, either that's risk management or taking better decisions, better and smarter and quicker decisions, is the next level thing. It will all heavily depend on the compliance and regulation side, which is actually, I'm always saying, it's a good thing. Like, the more compliance here is, the better, because then we'll have a proper set of rules, and then we will be able to adjust the rules in the way to bring the value that we need to. And the last part would be the actual technology, because the way technology matures, well, everyone who is in crypto knows that every, I would say, at least a year, but actually quicker, you have these huge changes that are probably not visible to the masses, but which make very, very complex things possible, things that were not possible before. So the switch is there, either that's stable coins or traditional assets or real estate or something else. So yeah, definitely a lot of big and interesting changes in the next 5 years.
A lot of green shoots to be paying attention to, suddenly. I know that I need to hold my mic a little bit more like this. Fabian, I want to turn to you to, I suppose, hone in a little bit on some of the points that Yuriy was mentioning. So from an asset management perspective, Yuriy was alluding to the different challenges and buy-side adoption challenges, more broadly speaking, that we're seeing. Custody comes to mind, for example, broader cybersecurity concerns, and so I guess it's that risk element, but managing that risk. What do you think are those the strongest barriers to entry that we're seeing from a traditional finance side moving on chain, and then with that, I suppose as well, moving on chain towards both tokenized assets and crypto assets, more broadly speaking?
As simple as it sounds, I think a key barrier is still the lack of knowledge. We need to educate and train people enough that they understand the benefits from tokenization, that they have the trust in the infrastructure, in the smart contracts and so on. So I think a key barrier is still lack of knowledge and lack of understanding. That can be addressed, obviously. A second one then, I guess, is that slowly but steadily the infrastructure and the players and the regulation is emerging very much to what Yuriy and Barnali have said before, right? I think we are not yet there in terms of what it really needs to have an institutional grade platform and infrastructure and ecosystem to include tokenized assets fully into traditional portfolios. That requires actually that the full value chain becomes on-chain. That is, investors being on-chain, assets being on-chain, the portfolios being on-chain, the vendors being on-chain. So that step or that journey still needs different steps to be taken. But I guess with education, with the advancing of the infrastructure itself, with additional trusted players coming into the ecosystem, that will evolve step by step.
Fabian, I have a question for you. So again, walking around the stands here, what it will take institutional players, and is there a real need to implement the newer asset classes? Again, let's talk about meme coins. So what would it take for institutional clients to actually get interested in offer, let's say, meme coins, ETFs for their clients? And do you see this happening in the next 5 years?
Well, thanks for the question. I'm not sure whether meme coins would be the right point in case for institutional investors to think about going into the asset class. Let me answer it a bit more generic. I think what is needed for institutional investors to come into the space is that they understand that there are really new sources of return and decorrelated sources of return. Now that can be provided either by tokenized real-world assets, in the sense that those assets become now investable, become liquid, become accessible and the likes, become tradable, etc. So that's one point, making existing assets becoming an investable asset. The second element, I think that through crypto assets, mainly there are additional use cases to be invested in, decentralized finance, maybe Web3, gaming and the like. So there are new use cases, new sources of return to be accessed. Again, I think that journey will take a number of steps, but ultimately my vision would be that there's no distinction made between traditional assets and crypto assets, but rather that we still speak about the same asset classes, but within the asset classes have different risk-return drivers. Let's take fixed income. You have the traditional corporate bonds, treasuries, government bonds, etc. Plus, you have decentralized finance revenue sources, right? Credit lending, liquidity provisioning, arbitrage, and so on. And that helps you diversify your fixed income portfolio with additional risks, but additional return coming with additional risks.
I would add, I think that's a debate wrongly framed, because
I didn't frame it.
That was the whole idea.
No. The point I was making, not from in terms of whether, but what I take issue is, not everything is meant to be institutionalized. I mean, casinos are a legitimate industry for years and years. So why are we even discussing institutionalizing meme tokens or certain things that are part of any sort of emerging market, right? I mean, whereas some of the things that Yuri pointed out, which I think is hugely helpful for crypto as a whole, is regulation, or more than regulation, it's really rules of the road. And as a driver on the road, or an asset manager, or an institution, you would like to know that if you are dabbling in a newer emerging technology slash markets, there are certain things to fall back upon. And I think that's the real value add of whether that is improvement with respect to institutions finally embracing, and I don't mean large asset managers embracing, but actual governments and infrastructure around regulatory and compliance control. And those things simply bring trust. The technology by its own origin will improve. That's just the nature of technology. There is always a 2.0 following 1.0.
No, of course there is. And I mean, I would really agree with that. So, I mean, just wearing my GDF hat for a sec, what we do is try and bring best practice standards to the market, drive adoption for across all market participants. And I'm a very firm believer in the rules, the road rules are there for a reason. They're there because we have a financial system that actually requires that backbone, and it's based on a value system, like it or not, that's there for a reason. Because when there have been problems in traditional financial markets, they've been put in place to essentially ensure that when that happens again, because it can happen again, that the rules of the road are there. So very much agree to your point on that, Barnali. I think so. We're coming down to the last few minutes of the panel, and I suppose I just want to do a little bit of a roundup on, we touched a lot on what this future looks like. I know Yuri, you have a very particular view, especially with the IPs, but I suppose what I want to think about right now, and just give food for thought for the audience, is what do you think is going to be the most significant transformation in the upcoming years that's going to sort of make that shift at least take place, or facilitate that shift within the asset management space a little bit more? So maybe, Fabian, if I can start with you.
Maybe coming back to my very point at the beginning, I think it goes far beyond the tokenization of assets per se. It really includes so to say, bringing the full asset management value chain on-chain. That means assets, portfolios, the different vendors and functions that are needed to manage a portfolio in an institutional sense. So also the depositories, custodians, the transfer agents, the NAV calculator, and so on. So to bring all of this on-chain. If I look back what happened over the last 5 years and look forward to what might happen over the next 5 years, I'm confident that we make a big step forward there, so that ultimately really the full value chain on asset management is in a certain sense tokenized or on-chain and benefiting from the various advantages that this technology offers.
Barnali?
I think it's hugely interesting that the regulatory framework across the world, regardless of jurisdiction, but most importantly in the main jurisdictions, is actually moving towards truly looking at the space and creating frameworks that the market can work under and kind of move towards the next level. That, in my view, is beyond just tokenization, but definitely tokenization plays a very critical role in, again, to my original point, combining those two elements of the financial world. What's super interesting is in 2024, obviously we've seen sort of the introduction of or adoption of US ETFs and related regulatory developments in that space, but it has also seen a host of tokenized assets being brought on chain. Just taking that trend forward, what I envision is that there is likely going to be a lot more tradable assets that were previously not available in the traditional world due to their nature of their construct, whether that's illiquidity, whether lack of fractionalization, yeah, et cetera, et cetera. And that widens up the opportunity for any asset manager to try and find alpha from different sources. And I think that makes for one of the most interesting part of the market, in any of the market right now.
And I couldn't agree more, but can I ask Yuriy to close up for us?
I would say that let's think about this in the following way. So the compliance conferences were there 20 years ago, and the regulation conferences were here 20 years ago, but blockchain and AI conferences were not there. So in this lifespan of 15 to 20 years, we've seen at least two major technologies maturing to a level where they actually help to solve real-world problems. So everything that Nal was saying about basically bringing more liquidity and everything that we've talked before, improving operations and everything else, compliance, security, blah, 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 it all comes down to why we are here. And we are here because the technology is actually changing the world. So we see it with our own eyes, with this particular asset area, for example, in our asset management sphere, right? So I would say that we kind of know where the technology is going, and we can figure out what will it help us to improve in the next 5 years. But the trend is, as everyone was saying here, in the end, more liquidity, fractionalized assets, and on every level, implementing the new technology that we have to make our world, easier, better, and more efficient.
Well, thank you all. I hope that gave everybody a bit of food for thought, but certainly, I think, again, with my little GDF hat, it's very much in line with a lot of the movement that we're seeing in terms of signals for institutional adoption, and not also when, to Barnali's point, that there isn't the need necessarily from the baseline at that. So thank you very much for your input. Really enjoyed the discussion. Thank you for keeping it lively. And round of applause for my panelists, please. Thank you very much.
Thank you.